Thanks for taking the time to join us in 2023's RHB Money Chat. It's, of course, a very interesting year, a very noticeable year because of the various macro outlook that is going to be impacting how we plan ahead and how we forge ahead when it comes to growing our wealth. And because of this, we have two rather senior individuals and, of course, very illustrious kind of characters here to walk through with us when it comes to what the first quarter of the market outlook is going to look like. Joining us for this Money Chat session is Fauzi Tahir, the Chief Investment Officer of Equity at RHB Asset Management, as well as Michael Chang, the Chief Investment Officer of Fixed Income of RHB Asset Management. Both capital markets, one handle the different side of the other. Fauzi, we start off with you. Now, despite the stock market being relatively flat with downside bias sliding along with the global equity market, and despite the political uncertainty in the last quarter of last year, the FTSE Bursa Malaysia KLCI was up 4% on 24th of November when our current Prime Minister, Datuk Seri Anwar Ibrahim, was appointed or was announced as the appointed 10th Prime Minister. The unity government has taken shape 1 month into the job. Some ministers are doing better than the other. The question now is, how does this go well with foreign investors? Do you have any revision or new target price for the KLCI for this year, Fauzi?
Thanks, Ibrahim. We believe political risk should ease in the near term. The investment community look forward to a stable government which could lead the country through these challenging times. The FBM KRCI was among the best performing market in the world since the appointment of the Prime Minister. Malaysia was ranked third behind Hong Kong and also the Chinese listed shares in Hong Kong. We performed 3.6% since the appointment of the Prime Minister, whilst other market in the regions actually dropped from 0.1 to 7.5%. However, foreign institutional investors have been selling Malaysian shares since the conclusions of the general elections. Cumulatively, foreign institutional investors net sold 1.53 billion of Malaysian shares. The index was pushed up by local institutional investors who net bought about 1.67 billion, whilst retail investors net sold about 42.1 million. Overall, foreign institutional investors turned net buy for the first time since 2018. They have been selling Malaysia market since 2018. And then last year, we saw for the first time net inflows from the foreign institutional investors of around 4.3 billion ringgit. They have been selling our market actually consistently since 2019, around 11.14 billion, and 2020 around 24.57 billion, and 2021 was 2.99 billion. Was the local institutional investors, we saw net outflows of 6.4 billion last year, and also retail investors remain net buy of around 2.7 billion last year. However, we are of the opinion that the selling by foreign institutional investors not only limited to Malaysia, as market across the region, we can see the market were down from 0.1% to 7.5% due to the fear of recessions in the developed economies.
Okay, Fauzi, but in your opinion, which would get more traction or better traction? Do you think that large caps would get better traction or the small cap stocks? There's always a saying, after election, invest in small cap. Do you hold this opinion?
Right, thank you. I think from the chart that you can see at the moment, there are two charts that I supply actually. The Bursa Boost Big Cap and Bursa Small Cap. The Bursa Big Cap is the Bursa KLCI index, and the Bursa Small Cap is the Bursa Small Cap index. It's obvious actually because from the chart, I will argue from earnings growth perspective actually, since at the end of the day, fundamental I think prevails. Although in the short term, the stock price might be volatile. We see better growth coming from the large cap stocks than the small cap stocks this year. The large cap stocks earnings growth double of the small cap stocks. So I think as stock price would normally follow the directions of the earnings growth, we would expect the large cap stocks to perform much better than the small cap stocks.
I also want to explore some of the ideas when it comes to the government policies. Recently, there is an increasing discussion on reforming subsidies, for instance, as part of its ongoing plans for Malaysia's economic recovery. There are, I guess, calls to be made in terms of unsustainable subsidies that could deepen further our budget deficit, forcing our government to perhaps borrow more, increase debt. However, if this is, executed poorly, it could have adverse effects not just to the government's coffers but to the living expenses of its people. Do you feel that there's any strategy or repositioning that needs to be done when it comes to investing portfolio or your own investment portfolio to anticipate this kind of economic movements or shocks that would happen sooner rather than later, Fauzi?
Right, thank you. In our view, the encouraging labor market condition and also the rising wage growth could help to support the private consumption in Malaysia. Looking into 2023, we expect the sector to be resilient with the expectations of economic growth, favorable government policy in the upcoming budget 2023, and also announcement and also the stable labor market conditions. What we saw actually, the employment growth actually quite steady at around 3.6% year-on-year growth, and also the sector wage growth, the private sector wage growth actually quite stable also at around 8% year-on-year growth. So that should actually support the private consumption in 2023 despite challenging actually economy. And also what we think, the reopening of China should also provide a boost in demand with the increase in the China domestic demand, and also the return of Chinese tourists. So what we have positioned actually, retail players actually should generally benefit from the inbound of the Chinese tourists and also their spending power.
Fauzi, what about commodities? What's your view on oil prices? Do you think that they are stable at around $80 per barrel? Do you feel that the impact on the oil and gas sector is going to be adversely impacted? And on top of oil or crude, we need to talk about palm oil price, because they are also falling fast from highs of 8,000 ringgit. Do you feel that the palm oil sector or palm oil stocks would be needed to avoid? What are your views on commodities, generally speaking?
All right. I think based on the forecast for oil, the market is expecting oil price to hover around USD 80 per barrel in 2023, and also 76 US dollar per barrel next year. This was reduced. Actually, the assumption from the consensus will reduce from 88 for 2023, and also $80 for 2024. The forecast was about 3 months ago, and then now actually the forecast came down to around $80. So there is about US dollar per barrel reduced in the forecast actually from the consensus, due to the upward trend of the global crude oil inventory, despite lower OPEC plus productions, despite full force of Russian crude oil sanction, and also despite potential relaxation from China. What we think, there are possibilities that the oil price might trend down lower due to the slowing economy. But for now, the global oil demand and supply is expected to be at parity of around 100 to 102 million barrel per day in the first half of 2023. Having said that, I think the Petronas continues to expect uncertainties in the energy market, but would maintain actually the capital expenditure around 45 billion to 50 billion for 2023, which is similar to 2022 uh, target actually. So in terms of Brent price target, Petronas is expecting the oil price to remain above US $60 per barrel, and also it's in line with their activities actually in the recovery, especially in the rig sections, the well services activities, as well as the underwater services. So in terms of positioning also, we would focus actually on the services sectors for the companies that are listed in the Bursa Malaysia as well. But for the palm oil price, actually we saw that it's falling from 8,000 level. We have already downgraded actually the sectors to neutral level since September last year, and also we have also reduced our 2022 and our 2023 CPO price forecast from 5,000 to 4,800 ton per ton, and also for 2023 from 4,500 ringgit per ton to around 3,800 per ton. So in general, we saw an average of about 13.9% year-on-year output growth for the companies that we covered last year. But most planters are now saying that the peak output quarter was third quarter last year, with fourth quarter 2022 to be slightly lower due to the current wet weather attributions to La Nina. And also what we see, most planters actually have seen some intake of foreign workers over the last 1 to 2 months. So with more expected to come by in the first quarter of 23, a bit slowly actually. The planters are now more optimistic actually on the output growth in 2023 with the resolution of the labor shortage.
Okay, and of course, maybe you can provide some sort of catalyst for some of our investors in Malaysia, especially in the equity market. Would there be some risk that we need to watch out for, including that of political risk, and some comments on that?
There are few catalysts that investors can look forward actually to Malaysia market in 2023. Among the catalysts that I think we think would be positive for the Malaysia market, the first one is the foreign ownership is very low at this level, at current level, at 20.6% as at end of October. And then also the expectations of less hawkish US Federal Reserve monetary policy in 2023 would also help ringgit actually to strengthen after a long spell of weakness. Then apart from that, Malaysia economy is expected to perform relatively well in the region, and our corporate earnings growth are also among the best in the region. Not forgetting that the index is cheap at the moment. The index is trading at 13.1 times PE compared with the historical average of around 14.8 times. So the index is attractive at the moment, and also is supported by attractive dividend yield also at around 3.9%, which is also relatively higher than the rest of the region actually. So there are catalysts actually that should provide support to the local market, and also I think that should also helps the market to perform in 2023. However, there are few risk factors that we need to watch out for also. It is expected that the COVID-19 infections would rise, with China taking tentative steps to open up its economy. Hence, we expect the rapid spread could affect the speed of the economic recovery in China, and also would therefore affect the sentiment of the markets all over again. And also, if US inflation remains sticky, and U.S. Federal Reserve would continue with its aggressive monetary policy tightening, and as well as the U.S. economy, if it goes deeper, it will also have it will also actually affect the sentiment of the market.
All right, thanks, Fauzi. Of course, Fauzi is the CIO for equity of RHB Asset Management. We now move on to the CIO of fixed income of RHB Asset Management, Michael Chang. Michael, let's talk about interest rates because we know that a lot of central banks are not done when it comes to raising their interest rates. Some of them may raise even for this quarter. How should investors position their fixed income portfolio in terms of the bond ratings and duration? And of course, in your opinion, how many more rate hikes it could be expected from Bank Negara for this year?
Sure, Ibrahim, and Happy New Year to everyone and to our audience here today. So, in terms of rate expectations for 2023, I think relative to 2022, investors should be adding duration because in 2023, the trajectory of rate increases will be a lot less than 2022. I mean, we had record increases in terms of interest rates for both Malaysia and also the US. But we think that in 2023, the amount of increases in terms of interest rate will be much less. So in terms of in terms of the current rates right now, US is now 4.25 to 4.5. We're probably looking at another 75 basis points to bring it up to 5% or so. For the ringgit side, currently we're at 2.75. We're probably looking at another 50 basis points for Malaysia. Top side will be about 3.25. We don't think that it would actually be above 3.5% for Malaysia because, I think inflation is on the expectations that it should be going lower in 2023. That will actually ease off some concerns in terms of having to raise interest rates higher to sort of manage inflation levels. So on ratings, I think that one depends on generally what is the investor's risk appetite. Generally, if they have a higher risk appetite, then they can actually go down the rating curve to actually seek out more yields. But having said, if you are looking for safer bets, safer papers, then I think the current yield would be attractive because the policy rates are already a much higher level compared to where we began in 2022. Yeah, hope that answers the question, Ibrahim.
Yeah, it does. And because of this, can we just tap into your ideas of or your opinions on high yield and unrated bonds? Do you think that the current economic recovery situation right now might entice some investors to consider higher risk debts?
Yeah, thanks for the question. So back to the question earlier, I would like to reiterate that high yield or unrated bonds, it's pretty much predicated on the risk appetite of the individuals. If they have a high appetite for risks and unrated bonds, then I think they do have that capacity to go into these higher riskier bonds. But having said, I mean, if you go into high yield or unrated, there's also high risk of credit and also liquidity. Um, in the past, in 2022, you can actually see that high yield movements in terms of yields can be quite dramatic, and also because this is due to both credit risk increases and then also liquidity risk. So if they have a sum up for this kind of risks, then by all means they could go into higher rated bonds. But if they are actually looking for more stable income and then for yield investments, then they can actually look into the lesser risk corporate bonds. For example, I mean, if you're looking at even for banking bonds, this is also something that they could consider because they give you the yield, and then they also benefit from the higher yield overall in given the rate rise in 2022. They should set to benefit in 2023 as well because of the higher net interest margins from for banking sector. So just to give you a bit of how high yield and also unrated has been. for the high yield, I think in 2022, they have one of the worst years in record for the past 9 years because, um, bond rates were up, policy rates were up, and that is why also the yield levels for high yield has also gone up more tremendous. I mean, more than in the year before. And then not to forget, I think liquidity has also been one of the main reason that also caused high yield prices to be lower. So I think I've put in some two charts here. One would actually spell out the what monthly performances of high yield and then monthly performance of investment grade. So for 2022, definitely it was a challenging year for bond, but I think that is set to change for 2023. And then I think if for me, I think looking at the IG investment grade space is also something that investors could consider on the balance of risk, credit risk, and also liquidity.
On top of this, I want to ask you about some sectors you think should be thought of when it comes to bond investments. And in your opinion, between primary and secondary market for bonds, which market would you consider as being more attractive given the current economic standing that Malaysia is facing right now?
Thanks for the question, Ibrahim. So in terms of sector allocation, it depends on the risk appetite of the investor. I mean, if the investor is more of a high risk investor, then it can look at the less favored sector currently, which is the Chinese property sector, which was very bashed down and unloved in 2022. In terms of absolute yield, it is attractive, but I think investors need to actually also consider what are the risks involved in investing in this sector, and also the liquidity of these papers, because generally the liquidity, it's quite sporadic, very sentiment driven. Our spreads tend to be wide, and these are the risks that investors could face if they want to get a higher return, at the same time also assuming more risk. So for more investors that are actually on the conservative route, then they can consider, especially for Malaysia, it's the banking sector, fixed income securities, because this sector stand to benefit most from the rate increase that has been happening in 2022, right up to possibly another two more hikes in 2023. So that as a whole, banking sector should benefit from profitability standpoint, and then also from a cash flow compared to where before in 2022. So geographically, also in Asia, I think investors should be looking at more Asian investments, because I think with the reopening of China, and then also Asia yield curve is also more attractive than the advanced economies. I think there are actually more opportunities in Asia as a sector and as also a region for investments. So I think that coming to the second question, whether is it primary market or secondary market for bonds in Malaysia, I think both markets have their merits. So I think I believe it's of course, with the help of the fund manager, I think these tasks will be made simpler, because they were able to give their fair view, and then also articulate what consider a level that's attractive both in the secondary or the primary markets. So and then also backed by fundamental credit research. So what are the comparing options or alternatives, cross sectors, cross yields? I think these are some of the insights that the fund manager could add or give value to investors. And in some instances, for some primary issuances, I mean, for fund managers' call is also to see whether that level is also attractive compared to secondary yields. So just to reiterate, why we also encourage some of the primary investments if the demand is good, is because generally they have a more demand primary issuances, because it gives a fresh flavor to the market. And when investors actually demand more for particular issuer because of a primary issuance, it also means that the capacity to get capital gains will also be higher for a primary issuance compared to a secondary investments in the secondary market. So I think that covers it. Back to you, Ibrahim. Thank you.
And on top of this, I want to pick your brains on the correlation between other currencies, major currencies, not just in Asia, but of course globally as well. What's your view on US dollar against renminbi, against yen, many other stuff related to it? How do you think that investors should respond to the fluctuations or the strengthening of the US dollars against major currencies?
Sure, Ibrahim. Thanks for the question. So, market expecting US dollar to peak after the US Fed fund raise in 2022 in record levels. So 2023, because of lower expectations in terms of rate hiking, that should actually put the US dollar to somewhat peak. But having said, I think in our opinion, this is less than a straightforward question because US dollar continues to be a safe haven demand for investors because there will still be some economic challenges in 2023. Although now with the reopening of China, then in terms of global growth, that should set some growth expectations to improve as well. So in terms of US dollar, they are still in a way for the US, there's still some form of battling with the inflation. So unless inflation actually comes into control, then I think that's where we actually see US dollar should peak in terms of its value and level. Just closely watch this, which is the US dollar index DXY. I think in the near term it should trade between 105 to 110 for the time being. So I would also like to talk a bit about renminbi in your question as well. I think in terms of the reopening that was happening now in China should bode well for renminbi. And now that we are doing away with all this surprise lockdown that has been happening in China in 2022, China should benefit from this reopening fully, and it should make a comeback in 2023. So we have actually seen, China renminbi weakened to like 7.3 in October, but we also saw it quickly climbing back to current levels about 6.90 versus the dollar. And then I think in terms of the medium term, we should see renminbi hovering around 680 to 7 against the US dollar. I think we also want to talk a bit about the yen. Yen should actually look into a bit more appreciation from here because with the reopening of China, and then I think in terms of global expectations, I think most of the economies have already fully opened up. So for yen, I think they would benefit some of these tourist flows as well. So the appreciation for yen should make a comeback in 2023 compared to them being severely bashed down in 2022.
Right. Thank you, Michael, for sharing those insights. Also, of course, thank you again for the early conversation that we had with Fauzi Tahe. Both Michael and Fauzi have shared very insightful ideas on what to expect, not just for the first quarter of this year, but generally the theme that will run through the entire of 2023. There are plenty more conversations that needs to be held when it comes to the kind of investment ideas and the kind of approaches that we can think, some strategies, some tactical moves that we can actually approach. So do stay on with view all of the Money Chat series that we have here on RHB because these could give you some insightful ideas on what to expect and how to react to it for 2023 onwards. Again, thank you again to Fauzi Tahe, the CIO of Equity for RHB Asset Management, as well as Michael Chang, the CIO for Fixed Income of RHB Asset Management. My name is Ibrahim Sani. Catch you in the other sessions of Money Chat.